Thank you. This is the obligatory mic check. Oh, good, it went over, perfect. Hi, I'm Meg Bannister, and yeah, that is mostly the title. But yes, this kind of break in the day, if you will, is to talk about how to apply some of the things you've heard today and maybe actually walk away with some ideas specifically around credit scoring. This is the obligatory slide, although I do have dates in my presentation. They are historic dates, so I should be okay, but we always want to cover ourselves if we have to, right? All right, so non-standard credit scores, I'll tell you a little bit about my background, but specifically, the reason we're taking Symitar specifically is because this is a common trend, or at least more common in the credit union space, right? Credit unions, a little more hippie, a little more hunky-dory, try to do things, but obviously is something that's being more prevalent in the community bank industry, and fintechs for that matter. So our goal today, while I'll be using potentially credit union terms, but I'm going to do my absolute best to be as agnostic as possible, the idea is that your core today, regardless of what you're using, how many you're using, if you have the digital core thing as well, is you have data today that could help get a better picture of your member or customer, and that information actually can help you not only find new business, which is important for deposits and loans, but also get a better picture of your member. And really, when it comes down to the picture of the member and what a credit score is, we're going to talk about where it historically comes from, why it exists, and then, of course, how are you going to apply it so you can bring something back, so you make sure that the reason you came here is you actually got some great ideas for your financial institution, right? All right, so I'm Meg Bannister. I lead sales engineering over in the CTO office. For those in the credit union space, you might recognize me. I used to run sales engineering for credit unions, but now because there's just more to credit unions than just credit unions, my team is now part of the CTO office. I live in Florida, that is proof, and the SimMeg nomenclature it's been my license plate since I started working at a credit union that used Symitar. So for 20 years, I've had SimMeg in either Vermont or Florida, and they can pry that plate from my cold, I will say that when I moved to Florida, it took me a long time to get the plate because everyone was like, what does it stand for? Well, Symitar. What's Symitar? Well, it's a software. And in Florida, for those of us in Florida, it way over their heads. It was too much for them. But that being said, we're going to talk a little bit about the history of credit scores. Don't worry, it's not boring, but it is very important as to why there's so much regulatory focus on what makes up a credit score, or more importantly, what doesn't make up a credit score. The year 1841, not going to be an issue for the future date issue of the slides. 1841, cool year. It's actually when the first opportunity is something called Mercantile Company, and Mercantile Agency and Company decided to actually figure out what their individual business members were doing not with them. Good idea, right? They actually used people, correspondents, so now we think about correspondent banks and files like that. No, these were legit people walking around. They went and collected information about data sets. So they would go to one bank and say, hey, the people in your commercial banking, how did that work? And they would go somewhere else about 100 miles away and say, hey, how about those commercial bankers? And the funny part is, these are the same bankers, because if you think they weren't running around kiting things and trying to get lending outside of their local area, you're mistaken, they totally were. But the focus here was on commercial, because originally commercial banking did have the idea of internal installment, internal concepts, and they would store this data on paper with a pen in a ledger. It was actually kept in New York City, so if that was happening right now, be a problem, because you probably couldn't get to it because this snowstorm thing. But the whole point of this is that this entire concept of using something with paper was because you needed to have a centralized database. So think of the original ledger as being for this as like the first database, the first SQL database, if you will, because it was relational, but it was entirely subjective. Because they would go and interview someone and say, hey, this company you're working with, how are they? They're stellar. Yeah, but they didn't look to see if maybe the owner of the company perhaps was the second cousin once removed of somebody who was at the bank, right? That wasn't a thing. So what they were really trying to do, and they were selling the data of people who weren't paying. Because there's value on the really good people that are paying everything, but more of the value comes from the fact that, they're not paying. Okay, so they started sharing these lists, and then in the late 50s, early 60s, and this is arguable in terms of exactly when it started happening specifically, there were up to 2,000 individual credit reporting agencies, okay? Mass retailers were the first ones, okay? Sears being one of them, because they had installment houses, right? You got the catalog, you had private financing. Now we have things like Fingerhut, and we have Synchrony Bank that do specialized things for that. But the real thing is that these installment banks, these within actual companies and stores, they had credit scores. So you can imagine that your credit score with Sears might be a little bit different than back then, or whatever Home Depot was back then, or perhaps a community bank or an ag bank, right? So it's all different things. So there were 5 big players in the data, and to speed this up, I'm not going to go into each of their histories, but as one does in technology, there were 5, they fought it down to 3, and you've probably heard most of the other 3 that are very common: TransUnion, Experian, and Equifax. There are other ones, I'm not saying that they're the best or anything, but they are the ones that you see a lot in these conversations. Okay, great. So then there's this FICO thing, and people go, oh, what is FICO? And for being correct, it's actually who is FICO, because it genuinely is 2 dudes whose last name were Fair and Isaac. Really good names if you're going to start up a credit reporting agency, right? Better than your last name being like Liar or Fire or something like that. No, Fair, Isaac, totally fine. And we can thank one company for their proliferation, okay? Because what FICO did is that they took all this data, right? They were essentially the first data broker, if you will, took all of this data and looked against this particular company, American Investment, and said, hey, we are going to customize a credit score just for you. We're going to look at your data set, we're going to look at this gigantic data set, and we're going to tell you, with a level of accuracy that probably wouldn't make an SLA today, we're going to promise you that these people are going to pay you back and be the best customers you're ever going to have. Great. All because of that, we now have FICO scores. But that's genuinely what's important. They learn data by going to other types of businesses. Now, this seems noticeable for us, right? We know this. We get APIs, we get data sets, we're used to this. But they literally had people go to different businesses and say, well, this company only uses lumber. Well, let's go talk to a feed agency, because we're cross-referencing people. And really what their goal was, supposedly, was to make it so they could offer credit to more people. Now, we'll talk about that in just a second. But the idea was that they were getting an idea of who these people were and why they mattered, and why, of course, what can we offer them. And so first came the first junk mail, where you get a credit card that you had no idea that you even wanted. How did they know you were just buying a house? Or how did they know you just got a credit card with Home Depot and suddenly Lowe's is offering you a credit card? The answer is you clicked OK on your little EULA that says, hey, share my data, it's totally fine. But no, that's literally what FICO was all about. And they created this rating system, and the rating system was designed to score you as a person against normalized data. So we went from customized data, which is their whole thing, to normalized data. So it really became more than just a yes or a no. Okay, so there's 2 concepts. You could be inclusionary. They're like, hey guys, listen, you're not offering credit to the right people. We have so many people that can get credit with us. They have a digital footprint today, right? I may not have a lot with one bank, but I might with another. I might have all my transactions on American Express. I might have none of my transactions on my Citi card. So how can you actually know who I am as a person? The answer is, well, we're going to put it all together and make it easier for you to get credit. The other side of this is that it could be exclusionary. And exclusionary is kind of where the problem happens, okay? Because there's these regulations, and we want to be right to people, and we want to make sure everyone's fair, right? Fair everything. Fair Isaac, you would think. But no, the exclusionary concept is that, truthfully, 26 million people, and that's a recent number, are considered credit invisible. What does that mean, credit invisible? Some people think it means low credit. Some people think it means no credit. Some people think it's just intermittent credit, right? They only use credit when they need it. But the end of the day is that their scoring model is not consistent. And we've all experienced this in some sort of way, right? You log into one app, it's like, you have a great credit score, and then you go to another app, and it's like, it's terrible, but nothing's changed, right? You know your credit score, you have an idea of your credit health, so why doesn't the score reflect the health? Well, it's because you need credit to get credit. And this has been the hurdle, and this has been the opportunity fallacy, if you will, when it comes to credit scoring, and really where a lot of financial institutions come today, because they're filling a gap, right, where people can't meet the need. If it was so easy to just get a car loan, there wouldn't be all the opportunities of places to get car loans, right? So one of the other things that was kind of found out, let's say the early 80s, late 80s, and as someone who defends dissertations essentially for a living at this point, one weird concept about how credit can be manipulated. Because at the end of the day, for those of us who know the APIs, you also know how they're figuring this out. So the best way to get somebody to get more credit is to put them as an authorized user. Right? Get somebody, put your son or daughter on your 20-year American Express, and they're going to walk out of college with a great credit score. Stellar. Is that really a good picture of how they are? Because right after college, I should not have had a credit card. Probably still shouldn't, but there you go. And the inflation concept, and if you're thinking to yourself, listen, that's just for people who have really high credit, big businesses and things like that. If you think that in your financial institution today, that you don't have people that pay someone to fake their payroll file, you're wrong. It's one of the biggest forms of fraud in financial services today is people faking payroll. and you think you can prove it, get a W-2, they can fake that too. And if you're really going to sit and wait for the IRS to give you a huge form and file back of their W-2s to issue a $5,000 credit card, listen, they're not going to do it, right? It's all about risk and reward. So inclusionary or exclusionary, how can you make this work? And for some of you, maybe you need to be a little more risk adverse and you want to be more exclusionary. There are safe ways to do this. And if you want to be more inclusionary so you can open up your portfolio, perfect. There's other ways to do that too. All right, so those of us playing the home game, if you've never heard of a credit score, here's what a credit score is made up of today. And I say today because 10 years ago it was different and last year it was different, so it's a little bit different year to year. But in general, it's made up of major factors like payment history. You're either late or you're not. That's it, okay? And we'll talk about how that can matter in a second. Then it's how much money do you actually have out there? So your credit score can go down because you paid something off. Makes no sense, but hey, welcome to Fair Isaac. Now, the length of the credit history is one of the main things that's really hard to manipulate because now a lot of those scores take into account authorized user status, but that also matters, right? Because how do you know they're an authorized user? What if it's a business card? What if it's reporting? What if they're paying somebody to report it not as an authorized user? Unscrupulous practices? No, say it isn't so. Now, the last two are probably the least impactful today, but that will change now with Affirm and other sort of like buy now, pay later type systems, your new credit and credit mix. The bottom one's also important because credit mix increasingly about 6 years ago was about 2% of your credit score. Now it's 10, and there's concepts that it's going to actually get to 15 or 20. Because what they want to see is your history across lots of different things. You might know how to handle a car loan, but maybe you forget your credit card payment every month. Not the same thing, right? Different kind of loan, different kind of ranking. So what affects this day to day? So instead of thinking of it as a score that's really high and you're like deducting points, it actually doesn't work that way. You actually start in the middle, and it kind of goes up and down based on certain things. And the ones I really want you to focus on as you think about your APIs and what data you have in your membership and your customers is that it's a time thing. It's just math. If you have one late in 7 years, right? Think of it in months, et cetera. It's different than if you have 5 cards and have never been late, right? You can mutually, and they're rated differently based on what you want, if it's a car loan or a credit card. But what I'm saying is that if you have more options, more credit mix, even though it affects only like 10%, it's going to augment the ratio of how many late payments you have, right? So what a great way to stipulate that, right, is to say, I'm going to have lots of cards and never be late on any of them just so I stop having a bad score with one. Not a great idea, right? But in today's credit world, this actually would work. The second thing is time. It's really hard to start building credit. And there's lots of ratios out there as well that say that most people, when they get their first credit card, they tend to add 2 to 3 more credit cards or installment loans within the first 12 months. You know why? Because they got credit, people are sending them offers, and they don't know how to throw out the mail, right? They get, oh, I got a card. Oh, I got a card. Trust me, the gamification of credit is why so many of these apps work and how so many banks get credit cards and how so many of us back in the day who worked retail had to push credit cards at your store. Right? Anyone ever worked at a retail store and be like, you got to get credit apps. This is why. It's gamification. The last one with credit mix, you need a loan to get a loan, but in order to get a loan, you need to have credit. In order to have credit, you need to have a loan. Again, very difficult and tends to be something that's exclusionary because it's hard. If you don't have someone to be an authorized user with, how on earth are you going to have credit, right? So, what happened last year? Why does this matter? Okay, so things changed last year. And when you think about credit scoring and you think about all of this, think about back to your financial institution. What are you guys looking for? Are you guys looking for more loans, for more deposits? Where are your money makers? Tends to be in these things called mortgages. You might have heard of them. In 2025, all of this non-traditional credit scoring ideas, right, coming up with ways to give credit, were kind of up in the air. People had things that they were going to work with, but then GSEs says, yep. GSEs said, yep, now we're in. GSEs are like Fannie and Freddie, right? When they said non-traditional sounds great, we can have more loans, everything had to change. So they're automatic underwriting systems, which if those have not written into them, they're a joy to work with. Very, very regulated. Their direct underwriter and loan agency systems are now allow non-traditional scoring based on their regulations. Don't worry, there's a link later in these slides when you get them that you can click if you would like to have some heavy reading on what a regulatory non-traditional credit score is. It's boring, but it's there. And what really happened is that it stipulates what's more important, right? So we're thinking about non-traditional credit scores. That means like if I'm paying my electric bill on time, if I've paid my gas bill on time, some of these things don't get reported. And if you're someone who's always rented, that's a great amount of history. If you've never been late, that's great when you're walking into a mortgage, right? Because, hey, I've never been late to my rent. Why would I start being late to a mortgage, right? Great indicators of past success. Now, they also said that non-traditional scoring has to have 12 months of valid data, which, again, could be augmented, right? I hate to say it, but people like to augment their data and things. But really what we're looking at, if you look at this slide of join, if you will, we started back in the 1800s of company-specific credit scores, right, with data being sold left and right, and then they come up with standard ways of doing credit, which is totally normalized and removes all the humans from it. Then we look for new customers and realize we're not getting enough customers, so we go back to non-traditional scoring, and now we have custom company-specific assessments. It's a cycle. We're used to it. So we're kind of in that cycle right now where you're noticing that credit, the economy is changing, people are changing, you have data, you want to do something to have a better picture of your membership or your customer base. Perfect. What's in it for you? Great question. I'm about to tell you. The truth is that all of these vendors who are part of your credit score systems, whether you're doing something with Experian, Equifax, you're buying scores, you're buying soft pulls, whatever you're having, they are working on their own non-traditional services to make you buy them, right? Makes sense. And there are systems out there already today, if you're using it, if you have a lot of international members, some of this may not be news to you, but what they're doing is they're taking all that data I just talked about, that you already have, that you're probably giving in some way through some sort of service, but that's another discussion to have. And the reason for that is that there's proof in the numbers that this is going to be more important than a traditional credit score. Because today, what we know is credit, I'm a millennial, I hate the title, but it's true. My generation is one of the last ones to really use credit cards. Everyone wants to use debit. They just don't want to have that sort of credit anymore. So how are you going to nix an entire generation of potential borrowers? You're not. That's the answer. So the first ones, if you wanted to get this non-traditional data today, you absolutely could. The big players are out there. First is FICO. They have something called the 10T model, which, bad naming. I'm accustomed to the ID 10T error that we're all accustomed to. Apparently, they're not in marketing, but okay. If you don't want to go with that one, because I would not be able to stop giggling every time I saw it, there is a VantageScore. And VantageScore is really common because it was the absolute first one to put more weight on payment history. So essentially, it does an algorithm check to see that, hey, you don't have that many types of loans, so we're going to automatically weigh your payment history. That is why a VantageScore can change so drastically the moment you get another mix. So you actually could add a mortgage and your credit would drop because it was so concerned, it has no payment history yet until the other cards you have, et cetera. That's why they kind of look different all the time. Now, open banking providers are also in this game, right? Plaid, Finicity, all those ones, they're all like, hey, you're brokering data, you can own your own credit score. Right? Because I'm now providing information. Not every provider gives to every other provider. I might have one card that uses Citi, what Chase uses another, maybe your credit union or bank uses a different provider, maybe you're using one of the lesser known ones, whatever have you. And then there's some for international. This is a big player in the space, Nova. If you have someone who has an international credit score, because when they come over from another country and they're here and they want to establish everything, they're at zero, even if they've had property and loans in another country. That's kind of silly, right? And then we get to the crux of this in the last 12 minutes of this presentation, which is all about internally built scores. And probably the most prevalent one in the market today is Navy Federal Credit Union. Now, Navy Federal Credit Union, a number of years ago, in order to help their membership, a lot of veteran-based and those of perhaps that did not have opportunities to build credit, were retiring and de-enlisting, et cetera, and saying, hey, I want to buy a house. And they're like, we can't get you a house because you don't have any credit. And they can't sell it over to Fannie or Freddie. So they said, we're going to keep them in-house. We're going to portfolio your loans, and we're going to come up with a Navy Federal internal score. What makes up the score? Nobody knows, right? Well, I'm sure an engineer does somewhere, and it's blocked under key. But what it really is that something very specific to Navy Federal. They look at your credit score, they look at your history other places, but they look to see what you have done with Navy Federal. So for example, if you've had your paycheck delivered there every single month for your entire 20-year military career, you're going to have a really high score. You know why? Because you're likely also getting all your payments out of there. So even if it doesn't appear on your credit, or perhaps your spouse has a loan, or you're paying for something else or childcare, they actually have your entire history right there in the system. So they know more about you than any FICO score or TransUnion or Equifax or any of that could ever possibly do. So Now, this model works with banking too. I mentioned Navy Federal, who, just as a credit union, they have a very specific seg market. They change their scoring to kind of match that. And the fact that you're military or family of military or active military, that does affect the score. But of course, these are only really told your score when you get an adverse action or when you request credit, right? So you can never have been a member, become a member of Navy Federal through their seg and say, hey, I want to get a loan. They come back and say, you're 700 with Navy Federal. I'm like, that's great. What does that mean? I don't know, but that's what you are. And now you know at Navy Federal. You can do this yourself, though. What makes up an internal score? This is behavior scoring, okay? And behavioral scoring is interesting because it really does depend on historic data. This is all data you have today, promise. You have it somewhere. The first one is cash flow and banking data, and this is just velocities. You're going to be looking at things like what average daily balance are. A lot of these are calculated fields already existing in your system. But what I like to talk about, especially with Symitar, is that these spending patterns have velocities that you need to store and compare. So for example, you might want to look at deposits over an entire year, not just your last direct deposit, right? You might want to see those deposits. You might want to see if those deposits have gone from mostly electronic deposits to mostly cash deposits, or if they've gone from mostly direct deposit, or if it's mostly PayPal, or if it's mostly DoorDash. Again, on paper, FICO doesn't know how much money you're making, right? That's your underwriting system. So they're actually scoring on the fact that, hey, you've paid your bills the entire time, but aren't you interested as a risk model of where you're getting the money? You'd like to think so. The next one is your recurring payment history. Now, this is pretty simple, right? At the end of the day, we report things. However, for those who don't have credit or are renting or doing things where they have the ability to actually submit those types of scores, they're actually submitting records of their payment history. Now, you always wondered why people were saving their statements from like a water company. Now you know. They can prove that it's been paid. Now, if you get 12 months of that data, it makes a lot of sense, but you know what? How hard would it be for them to go in and actually see that they have those statements? I'll be fair with you, I don't even know it's on autopay. But you could go into their banking data, right? And you could see that they've paid the same provider. Like I pay Tico a stupid amount of money every month to live in Florida. It's just how it is. Now, alternative data, this is for inclusionary or exclusionary. If they're paying payroll, payday loans, payroll providers, and all the fintechs, right, the Daves, they all have names for that, to be able to go in and get like a quick payday loan. Is that actually a sign of non-payment? No, but you can use it as a risk flag. And these are companies that advertise that they don't report bad news. So if you use a payday loan provider, they'll say, if you pay on time, we'll report it. You don't, we won't. Okay, great, that sounds awesome, but at least you have it in your history. So you're really getting them to have more of their data with you, and you're able to actually use it to be more inclusionary. Now the last two, I'll leave for the last three. These are all things that require some sort of work with your member or customer. The consumer permission data set is where I actually see a huge opportunity for a lot of fintechs and for a lot of financial institutions. This means that you are actually reporting to a credit provider as a service. So Experian Boost does this, and if you've never seen it before, you log in and you say, hey, here are my providers. They're essentially taking the non-traditional data and forcing it into their proprietary Experian algorithm and supposedly boosting it. And then you pay for it, and then it doesn't boost it, and then they sue Experian. But a conversation for another time. That idea is actually an offering if you think about it, if you've got a member or customer set that perhaps are the underbanked and perhaps are looking to build credit. This is an actual service. There is no regulatory requirement saying you can't provide consumer permission data. So again, just an opportunity to think about if you're really working in the building of the credit class. And then the last two, I get a little bit iffy on because, of course, there's socioeconomic concepts with this. Metadata, when it's things like what kind of phone are they using, right? If they always have a new iPhone that says something about their credit history, I'll be fair with you, I have a corporate iPhone. I don't even know what version it is, and it has a cracked screen. So I probably shouldn't use it as my main ability of saying what my ability to pay back is because my company pays for it. But the employment and education data, again, this is all public record type data, which some folks will use it as a way to include. That's your mileage may vary. You know your mindset and where things are. Navy Federal actually reported a number of years ago during a housing market lawsuit that they were part of that this was actually a huge part of their algorithm, and they've since redacted it. So again, your mileage may vary. So the model, everyone says, well, I have a great idea. I want to do this. I want to be inclusionary. I want to be exclusionary. Let's be real. You need both, and they need to work together. So this is an actual example. These are taken from those, I'm working on my dissertation, and these are from folks who are genuinely part of it. They have signed up, and they give us data. We're going to take person A. Person A, they have an average daily balance of $10,000. Must be nice. And in the last 2 years, though, it went up to that. It used to be less than $500 a day. Okay. They get large direct deposits twice a month. Makes sense, payroll, probably not commission-based, right, because they're steady deposits. They've had 10 overdrafts this year. pretty much every month, right? Maybe as they get to the end of the month, but it's always rectified, right? So they pay the fee, whatever, and they're always fine, and they have an average daily balance of $10,000. They also pay off every one of their credit cards, all 4 American Express, 3 Citi, bunch of Synchrony. They pay them off every month, so they look clean on paper, but this is their behavior, okay? Person B, same financial institution. Average daily balance, $1,000. It is consistent. It's been consistent for years upon years upon years. They have daily direct deposits, right? They do the cash out daily from all sorts of gig apps. So they're essentially cash, but they are doing it through the electronic means. So they're getting some sort of reporting. They're getting some sort of I-9 or 1099 at the end of the year. They have no overdrafts at your financial institution. Now, I say at your financial institution. At this point, we don't know if they have a check systems or somewhere else, but at your financial institution, 0. They have 1 credit card, just 1. It's for emergencies, and it's with your bank or credit union. That's it. Maybe it's a $500 balance. I think it's under 1,000 in this particular case, but again, small. And every single one of their bills comes out of your checking account that you have, okay? Whether it's bill pay, whether you're paying for bill pay, whether you're actually cutting a check or something like that. The truth is it's all coming out of there. So the real question is, which one is the better customer or client for your financial institution? On paper, A has a 750 FICO score. On paper, B has a 600. The numbers don't indicate really the quality of the member or customer to your financial institution. That's the important part in all of this. Because you have so much more data on B. Look at A. A is just paying off everything. That's great. Must be nice. But when they're doing it, they're not doing it with you. That means they're using their credit cards to buy stuff, and then you're paying those credit cards. Are they bringing you any money? Is B? Most likely. So again, there's always more to the conversation. So your task, if you will, is to think about, when you look at non-traditional credit scoring, your goal, of course, whether to be inclusionary or exclusionary, is really to identify who are the members you should be offering it to, just like Mercantile Company did in 1841. Real throwback there. Of course, some light reading. Of course, I expect you all to read this, but as any good dissertation goes, there's tons of bibliography. But what I do in closing want to make sure you're aware of is the fact that you are more than a credit score. Your members and customers are more than a credit score. So have a decision on, use the data you have today. If you know me, you've heard me say this before. You have data. You're spending money to store the data, to make sure it's there, to make sure it's valid, to make sure it's compliant in PCI. Use the data, and maybe you'll help a member or customer in the meanwhile. I appreciate your time. Thank you, everyone.